The Federal Reserve System, commonly known as the Fed, is the central banking system of the United States. It was created in 1913 with the passage of the Federal Reserve Act, which was signed into law by President Woodrow Wilson. The Fed is responsible for implementing monetary policy in the U.S., which is the process of managing the supply and demand of money and credit in the economy. The Fed plays a crucial role in the U.S. financial system, and its actions can have far-reaching consequences for businesses, households, and financial markets. One of the main roles of the Fed is to regulate the nation's financial system and ensure stability in the financial markets. It does this through a variety of tools and policies, such as setting interest rates, regulating banks, and providing financial services to the government. The Fed also plays a key role in the payment system of the U.S., processing billions of transactions every day. The Fed is a decentralized system, with 12 regional banks located throughout the country. These regional banks are responsible for carrying out the policies of the Fed in their respective regions. The Fed is governed by a 7-member Board of Governors, which is appointed by the President and confirmed by the Senate. The Chairman of the Board of Governors serves as the leader of the Fed and is considered the most influential person in the world of economics and finance. The main policy tool of the Fed is setting interest rates, which it does through its Open Market Operations Committee. Interest rates are the cost of borrowing money, and the Fed can raise or lower them to influence the demand for credit and the supply of money in the economy. When the Fed raises interest rates, it can slow down economic growth by making it more expensive for households and businesses to borrow money. On the other hand, when the Fed lowers interest rates, it can stimulate economic growth by making it cheaper for households and businesses to borrow money. In addition to setting interest rates, the Fed has a number of other tools at its disposal to implement monetary policy. It can adjust the reserve requirement for banks, which is the amount of money that banks are required to hold in reserve against deposits. The Fed can also use its lending facilities to provide short-term loans to financial institutions. These tools can be used to influence the supply of money and credit in the economy. The policies of the Fed have a significant impact on the economy and financial markets. Changes in interest rates can affect the cost of borrowing for households and businesses, and can also influence the value of the US dollar in the foreign exchange markets. The Fed's actions also have implications for the stock market, as changes in interest rates can affect the profitability of companies and the overall level of economic activity. Certainly. In addition to its policy tools, the Fed has a number of other functions and responsibilities. For example, it acts as a lender of last resort to financial institutions in times of crisis, providing them with the funds they need to meet their obligations and maintain stability in the financial system. The Fed also plays a role in consumer protection, by setting standards for consumer lending practices and regulating the activities of financial institutions to ensure that they treat consumers fairly. The Fed is also responsible for the supervision and regulation of the nation's banking system. It sets capital and liquidity requirements for banks, conducts examinations to ensure that they are following the rules and regulations, and takes corrective action when necessary. The Fed also plays a role in bank supervision and regulation through its participation in the Financial Stability Oversight Council, which is a group of financial regulators that monitors the stability of the financial system as a whole. In addition to its regulatory responsibilities, the Fed provides a number of financial services to the government and to financial institutions. For example, it acts as the fiscal agent for the U.S. government, handling the issuance and retirement of government securities and the processing of government payments. The Fed also provides financial services to banks, such as check clearing and electronic funds transfers. Overall, the Federal Reserve System is a complex and multifaceted institution that plays a critical role in the U.S. economy and financial system. Its actions and policies can have significant impacts on a wide range of economic and financial variables, and it is an important player in the global economy as well.